Now that we have an understanding of trading systems, we have to address the larger ingredient of successful trading, which is psychology. You not only have to understand your emotional preferences, you need to know the loopholes in our mind, through the biases we have in our thought processes. Let's get started. A basic source of problems for all of us is coping with the vast amount of information we must process regularly. The conscious mind has a limited capacity to process information, even under ideal conditions. Once we've made up our minds about those beliefs, we are not likely to change them. So based on our beliefs, we subconsciously zoom in on information that confirm our beliefs, and very often ignore information which are important. When we play the markets, we assume that we are considering all of the available information. First, we'll cover biases that distort the process of system development. Most of the biases covered fall into this category. Next, we'll cover biases that affect how you test trading systems. Finally, we cover a few biases that might affect how you trade the system you've developed. We begin with biases that affect trading system development. Firstly, people assume that when something is supposed to represent something, that it really is what it is supposed to represent. Thus, we assume that the daily bar chart is the market, or that our favorite indicator is the market. Instead, it is just a shortcut for representing a lot of information. Secondly, people assume that something is accurate, when it may not be. For example, market data that you use in your historical testing are often filled with errors. However, unless you assume that errors do exist, you may make lots of mistakes in your trading and investing decisions. Lotto bias refers to the thought process, where people believe they have control over the lottery prize, simply because they are selecting the expected winning numbers. Likewise, people want to control the market, and so they tend to focus on entry, where they can force the market to do a lot of things before they enter. Unfortunately, once they enter, the market is going to do what the market is going to do. And the golden rule of trading, that of cutting your losses short, and letting your profits run, has nothing to do with entry, and everything to do with exits. In the law of small numbers, people tend to see patterns where none exist, and it only takes a few well-chosen examples to convince someone that a pattern has meaning. When you combine this bias with the conservatism bias, which we will discuss next, you have a very dangerous situation. In conservatism bias, once you believe you have found a pattern and become convinced that it works, by means of a few well-chosen examples, you will do everything you can to avoid evidence that it does not work. Next, for randomness bias, people like to assume that the market is random and has many tops and bottoms, that they can trade easily. Yet the markets are not random. Distributions of prices show that markets over time have infinite variance, or what statisticians call long tails at the end of the bell curve. Furthermore, people fail to understand that even random markets can have long streaks. As a result, top and bottom fishing is the most difficult type of trading there is. As for the need to understand bias, we attempt to make order out of the market and find reasons for everything. This attempt to find order tends to block one's ability to go with the flow of the markets, because we see what we expect to see rather than what is really happening. Moving on to biases that affect how you test trading systems. For degrees of freedom bias, we want to optimize our systems, and we believe that the more we manipulate the data to fit history, the more we know about trading well. Instead, you are much better off understanding how your concept works, and only doing a minimum amount of historical testing. For the post-predictive error bias, we can use data in system development that, in real-life trading, will not have yet occurred. For example, if you factor today's close into your analysis, then you will probably do very well in your testing, especially when you tend to exit before the close. The last bias in this category, not giving yourself enough protection bias. People fail to consider that position sizing and exit strategies are a key part of trading. Consequently, they often put too much of their capital at risk in a given trade. In this final portion, we explore biases that affect how you trade your system. Gambler's fallacy bias happens when people assume that the probability goes up for a win after a losing streak, or up for a loss after a winning streak. Next, conservative with profits and risky with losses bias happens when people want to take profits quickly, and give their losses some room. This gives them the illusion of being right, but what they are really doing is cutting their profits short and letting their losses run. And the final bias is called the "my current investment must be a winner" bias. This bias may be at the root of all other biases. Now that you understand biases in trading, let's move on to numerous other topics from AsiaPacFinance.com.